Welcome back everyone to Buffett Analysts. So today I'm going to be looking at FinViz, and I'm going to actually just use only FinViz for this video. I want to see, just how many stock tickers I can get through in a video. So, things have been slow. I've been finding potentials in stocks like Airbnb, YETI, and so forth, but I have problems with companies that sell products that come in waves and trends because they're very unpredictable for long-term investment. So what I'm going to try and do is use what FinViz has on their website at my fingertips. Right now, I can check their industry, country, market cap, price over earnings, price over growth, sales, and book value in cash. All their EPSs for this year and the past 5 years. I'm never going to look at the next 5 years or the next year because they don't know what the EPS is going to be. And their dividend and ROA and ROE, those are the numbers will look at, as well as current ratio and quick ratio, and margins as well compared to the industry. So all this information, and I will talk about it as I go, what each of them mean and the significance of it is. But that's what I'm going to be doing in this video. So it's going to be a little bit quieter. I'm just going to be doing my own thing, but you guys can definitely watch and listen in as I, sort of interrupt with a few pieces of information here and there. All right, so all right. So this company is large, it has stability, however, and it has a 33 PE ratio. However, the ROE does not justify the purchase. OTTR has promise at only 11 PE. Pretty conservative book values in relation. One concern is the EPS this year hasn't changed, or the past couple years, but the past year, 5 years, they've experienced growth. But their financials are also impressive because they have not only a dividend, not only a high ROE compared to the others, but also a high operating margin compared to the others, and good ample working capital and current ratio for their current liabilities and assets. Also, utilities don't usually go out of style, which is a good sign. Uranium from 19 to 21. Too volatile. Too expensive. Too volatile. Alright, now for trucking. 22 to 25. So the reason why I'm taking note of the numbers is so I can compare across the industry. Yeah, but it's low compared to the others. Probably not good. Take a look at 25. You maintain this spread of like 8 to 9%, which is weird. Yeah, they're not so shareholder friendly. So Saya is out, 26 is out. Yeah, I mean, that leaves ODFL with this. I mean, ODFL is a solid company. No doubt about it. Seems they've been dedicated to a share repurchase program. A good sign. Not so much a dividend. But they are at a P of 33. Alright, I'll give them a chance. It's expensive. But we're in expensive times right now. Hence why we haven't found a lot of good finds. Alright, 26 and 27 are travel services. Both from the USA. This one is much lower than Expedia, which is interesting. Let's see. TNL versus Expedia. Much less growth than Expedia. Operating margin is impressive. Okay, it looks like they're missing some information. Oh no. Sometimes it gets into this glitch where it thinks I'm a robot over and over and over again. Oh my god, what is going on? I just want to see. This is so weird. It's as if it doesn't want me to see its financials. Look at this. Try deleting your cookies. Just want to know its current ratio, first of all. Okay, it doesn't show it on the balance sheet. We gotta do it ourselves. It looks like this portion is current, so $4.528 minus looks like this is the current liabilities. Okay, they have working capital of like 3.24 billion. That's a very, very large current ratio. Even if we were not to include the inventory as the quick ratio, they would have much greater than 1. So that's a good sign, potentially. Let's find their return on invested capital. So that's going to be current operating assets. Start with this plus this 2.562 plus 1.206 3.944 minus non-interest bearing current liabilities, so 0.05 minus 0.788 minus 0.453. Debt does carry interest. We're going to use the deferred income, so minus 0.709. And then we're going to add in the other property, plants, and equipment, goodwill, etc. So 0.596 plus 0.968 plus 0.216 for intangibles. So 3.724 in billions is our invested capital for June 30th of 2024. And if we look at what they actually earned for 2024, we can get their net income. So attributable to shareholders, this is what it looks like. 195 minus 157, 38 million added to last year's number, because that was the discrepancy between the last 6 months of this year and the last 6 months of, or the first 6 months of 2023. So we're going to go to the 10K 2023. We're going to find financial statements. Getting excited, this could be something good. Net income right here, we're going to add 38 to that, which was our value for the discrepancy, and then we have 434, so 0.434 in billions is our net income for 2024, and they have a return on invested capital of only 11.7%. Do they pay dividends? They do. So we're saying about 136 million in the current market cap is 3 billion, so 0.136 divided by 3, it's It's about a 4.5% dividend, and it says it right there. That's actually substantial, very substantial. Let's check their shareholder equity. Common shares outstanding is decreasing over time. Not bad at all. And then I'm going to look at their margins. So it says they're much higher than Expedia's in operating margin, at least. So 350 was for 2023. Net cash provided by operating activity, so that would actually increase 111 between 2023 and 2024. So I'm going to add that to the 2023 annual value. So 111 plus 350 is 461 for the operating margin, for the operating income, and then divided by minus 12 million for the revenue. That's the discrepancy. So it's going to be 1637. So that I'm getting the revenue because in order to get operating margin, here I'm going to type it in: 461 million divided by 1.637 billion. 28% operating margin. And then now I can just look at Expedia's macro trends operating margin. So it's only 8%. Oh, there we go. Compared to TNL, which is saying right now is about 19%. We got 28%. So slightly different number, but... Oh, wait, we got the operating cash flow. That's why we didn't get operating income. We were supposed to do this number, this right here, not operating, net cash operating. So we're just going to make sure that they have the right answer. So 17 million is our discrepancy. 17 plus 720 is 737. It's saying about 45% operating margin. Oh wait, net revenues. No. Net revenues is this number. Sorry guys, I'm messing up big time. Okay, 985 minus 949 is the discrepancy. 36 million discrepancy, and then plus 3750. 3786. So this is operating income divided by the net revenue for 2024. About 19.4%, and yeah, that's exactly what Macro Trend says. So yeah, I mean, they have operating margins far above their competitor Expedia. I don't know what the exact difference between the two businesses are. Oh wait, it's more about timeshare properties rather than like an agency or, website. I don't really know what that means though. What is timeshare? I'm going to read up their business overview. What are travel clubs? Oh, I see. Members vacation together and receive group rates. Oh, I see. So it's sort of the franchise. Oh, I see. Oh, so it's kind of like a REIT almost. Wait, really? Travel membership business. Oh, I see. Yeah, so they kind of manage. Right. Okay, so yeah, there are people who buy parts of fraction, either a title or to a fraction of a unit through a points-based system or the right to use a property. So they buy that. So that's a VOI sale, and this company sells those to people, but they also develop and acquire vacation and ownership resorts. So they are very similar to a REIT, it seems. Interesting. It's sort of like a giant franchise REIT because they are like the franchise owners, and yeah, it's a very similar to a franchise. Interesting. So this is sort of the franchise for all the Wyndham hotels and brands. Okay, I sort of understand it now. Just like McDonald's. Just like McDonald's. In fact, I wonder how similar their operating margin is. Okay, it's not that similar. But that is very interesting. I mean, it says it's only a PE ratio of 7.85. Wow. Yeah, I don't think that's justifiable. I mean, they definitely experienced growth. And then COVID happened, boom, and now they're recovering slowly, but they're recovering. Revenue? I see what's going on. Okay, so their revenue has been declining slowly since 2015. Okay. Yeah, I don't know. Then I'm not feeling this stock because I usually want to invest in stocks that have a little bit of revenue growth. Sales past 5 years went up 2.47%. Yeah, that's not good. Not good. And in fact, now that I see that, even though this wouldn't have affected anyway, I'm going to do sales growth past 5 years at positive. Alright, and now I'm going to go back. Right now I have very basic. I literally just have the market cap because I want a bigger company over 2 billion and EPS growth over 10%. That's a given. It's a risky play to not do these two things. Positive revenue growth in the last 5 years and EPS growth in the past 5 years of 10%. Very reasonable. Okay. I'm trying a more flexible outlook on this, rather than, constricting with as many filters as I can fit on the page. I think this is better. I think looking at it a little bit more flexibly will help me find some stocks, undervalued stocks, because they're so rare. Say it's about $8 per share. Giving them some room. like a 24 PE ratio. Is it worth it? That is the question. They do pay dividend. Pretty impressive dividend. This is giving me the estimated earnings, estimated net income, 464 million. Balance sheet, shareholder equity. Yeah, that they do have a high return on equity. Let's check their invested capital. So let's go official. We'll find their 10Q. People playing some terrible music outside. It's okay. Okay. Net income for 2023 was 545. The discrepancy is about 24 million. So this minus 24. Alright, we're looking at 521 revenue for 2024. Sorry, net income. And then now we're gonna calculate their most current possible invested capital number. It's unaudited, but it seems like it's not horribly out of proportion to last year, so I'm going to use these values. Or actually, can I just get an audited version if I go before 1 month? It's fine. It is fine. Accounts receivable 0.549 or 549 because we're doing million, so plus 583 inventory. I'm not going to include other right now. I'm going to also add property, plants, and equipment plus 584 plus 791. Alright, and then subtract their non-interest bearing current liabilities. So trade accounts payable 351, so minus 351. Accrued compensation and benefits minus 159. Other current liabilities. I'm actually going to include this because it seems like they already showed short-term debt, so I don't think that this would have interest on it. Alright, and now let's also just check out other current assets while we're at it. Yeah, so it's also kind of these contract assets. I'm going to include this as well since I use other current liabilities, so I'm going to add 208. Okay, so we have invested capital of 1893. This is their ROIC, 27.5%. Pretty impressive. I don't know, tools and accessories. So what exactly does that mean? Because they also have good current and quick ratio and high margins. And they pay a good dividend, but they also seem to be having a decrease in shares outstanding. Yeah. So what exactly do they do? What is their business? Okay, it doesn't seem that trendy or, unpredictable products, because they do sort of, basic equipment. Seems like they don't have a lot of direct competition. It varies. Just trying to find a company to compare this to. Okay. Also, just a quick note, don't discount a company or give it a better outlook just because its tone in the 10K. You can't tell based off, how the tone comes out, whether the company is strong or not. Definitely not a novice. Yeah, it seems like they're all around 20 PE ratio. Here, let's put in some of these into their operating margin and see what comes out. Operating margin is growing. Alright, I mean, this 25% is the goal operating margin, and they're only at 17, so there's actually room for major growth in the operating margin. Whoa. No, I'm not gonna. Okay, so seems like a very solid stock. Potentially one I'd pay good money for. Because they have high ROIC. So I'm going to write this all down. High ROIC. Solid dividend and share repurchases. Size. Little direct competition. To no direct. They also have a product that doesn't easily go out of style, in quotes, or trend. Alright, and then what do we also say? Oh yeah, they have a good growing operating margin with room for growth to meet the higher levels of comparable companies in tools industry. Yeah, see, this is Snap-on, another tool maker, and they're about 27%. Alright. Pretty good stock. A little bit expensive, but not too bad. Thermal coal, I'm not even gonna try with it. I mean, APA I've been looking at, or ARLP I should say. EPS, it's very volatile. I would not invest in this. Look at that, EPS this year, and look at the drop off. I don't know. Charter Communications is kind of in trouble. We haven't gone to there though. I'm still looking at 26 and 27. Okay. Pretty comparable financials. I mean, they're almost the exact same size as well of company. But ARLP is slightly less undervalued, slightly less overvalued, I should say. Yeah, I mean, thermal coal, probably not a good long-term investment with the rate of clean energy resources coming out. Alright, we're going to next look at row 28 to row 32. Pretty comparable PE ratios except for T-Mobile. This is kind of interesting. LBRDA. They've had insane growth, but their PE ratio is low. I mean, let's see. It's like basic EPS. $1.36 times 4. And then LBRDA. $11. Revenue hasn't really moved. Pretty unimpressive margins and financials. A little bit too unimpressive. But their earnings seem to be undervalued slightly. Yeah, it's not undervalued enough though. At 11, that's pretty neutral, and I'd say the business does in fact have neutral prospects in terms of earnings. I mean, does that make sense though? Is that true? Don't they own like Formula One or something like that? Yeah. Broadband communication? I don't know. Is that gonna stick around? Who knows, man. Do they pay a dividend? No. What are their subsidiaries? I need to know that. And what's the difference between this one and this one? LBRDA versus LBRDK. They're like the exact same company. One may be a higher class of stock than the other. Are they the same price? Yeah. Oh, wait, no. Yeah. One may be voting shares. That's possible. I want to see what their subsidiaries are. Whew, kind of tired today. Very hot. Shouldn't have clicked that. There we go. Okay, business. What do they do? No music? Okay. So random. How am I supposed to figure out what they really do? A lot of streaming. Yeah, I got into this with Paramount Global. It's very dicey. We just don't know where it's going to go. And 11 shows neutral prospects, so it doesn't seem that undervalued if we don't know where the business is going to go for sure. I'm going to move on. All right, steel. This is going to be interesting. And in future videos, I'm going to just kind of go through and continue in this journey through 32 pages of stocks. I bet there will be plenty of possibilities. $33 to $37. Steel Dynamics. Possibly undervalued. Let's see. Revenue growth. And they only have a 9 PE ratio. Net income, relative stability, and growth. Except in the recent years with the falling in the price of steel. But what are their margins compared to the others? X. New core. Steel Dynamics has pretty much the same operating margin as its competitor. What about that other one I saw, GGB? This had a lower one too. Yeah, it's around the same. Okay. Net income. All right. It's pretty interesting. I wonder what it says for their return on assets. Seems like it's higher for Steel Dynamics. That is interesting. Are they... I mean, I saw they have a dividend. Are they investor friendly? That looks interesting. Can I say that about the others? Yeah. Okay. Seems like it's increasing. Yeah, Sherlock. Definitely on the high side. What's their stock performance? Pretty good. Yeah, I mean this is high for an industrial stock. 9 is high because it's so volatile. You have no idea what's going to happen to steel prices. Let's calculate something real quick. $2024 net income coming right up. Discrepancy of 437 million. So I'm going to subtract that from the 2023 number. 2030 is our, so that's in billion, that's in millions, so that's 2 billion in net income in 2024. Now I'm going to find the invested capital to get the return on invested capital, and I'm going to use the 10Q. Okay, 10Q. Operating current liabilities, so that's not short-term investments, that's not cash, because they're not operating, hence the name. And then accounts receivable is operating, so 1696 plus 79, so I should say 80 to round up. Inventories 3074. Other I'm not going to include, it's kind of negligible. I'm going to add property, plants, and equipment, so plus 7434, plus intangibles, so plus 242, plus 477, negligible. Alright, and then minus non-interest bearing current liabilities, so minus 1205, 1206, minus 8, minus income taxes payable at 6, minus accrued payroll and benefits at 277, minus accrued expenses at 344, minus, that's it, because long-term debt does have interest, so 11162 in millions is our return on invested capital. 18% return on invested capital for STLD as of June 30th, 2024. Now I want to compare them with Nucor. Discrepancy 2818 minus 1671, 1.147 billion. I'm gonna subtract that from the net income attributable to Nucor stockholders, so 4525 minus answer 3378 is their net income for 2024. Now I'm going to get their invested capital, Going to the balance sheet. Once again, current operating assets, so that's going to be this plus this. Not this. Now I'm going to do this. Sorry, this is PP&E. Plus goodwill. Plus other intangibles. And I'm not going to include other assets because it's a negligible amount. So we're now at 27.4 billion. We're going to subtract the non-interest bearing current liabilities. So that's not short-term debt. That's not the current portion of long-term debt and finance lease obligations. That is accounts payable. So subtract 1745. Subtract salaries, wages, and related accruals. So that's going to be 857. 857. And then minus accrued expenses and other current, so it's going to be minus 1019. Boom. All right, 23,798 is our invested capital. Okay, so it's pretty similar. This is the return on invested capital for Nucor, which is a larger company than Steel Dynamics, and this is what it is for Steel Dynamics. 18.2% versus 14.2%. Both are very low. Both are relatively low compared to the values that we have been finding, for instance, for Lincoln and Electric, which was like 27, if I remember correctly. So, we found 3 potential new stocks: Otter Tail Corporation, and is a holding company which engages the energy infrastructure and production business. It operates through electric manufacturing and plastics. The electric segment is involved in the generation, purchase, transmission, distribution, and sale of electric energy, so they're a utility company. Next is ODFL. Engages in the provision of regional, interregional, and national less-than and truckload services through a single integrated union-free organization. Trucking company. Finally, Lincoln Electric. Tools. Welding tools, things like that. Manufacturer of arc welding equipment, consumable welding products, and other welding and cutting products. It operates through America's Welding, International Welding, and the Harris Products Group. Yeah, so that's the one that I think probably has the most potential out of the 3, because they are in an industry that has some growth, or their earnings show growth, but at the same time, I don't know, the industrial industry doesn't always grow as fast, and so price to earnings ratio of 22 may be considered expensive. So we're going to keep looking, and I have hope that we will find our golden stock that has shareholder-friendly management, a product that is not unpredictable and prone to trends and waves constantly, and that has a stable customer base. Also, a high return on invested capital. At least 20% is what I'm looking at. A low PE ratio, at least probably under 15. To get a good earnings yield boost, and just growth and stability and size, and I think all those things combined can create a really great company. Am I missing anything? And a conservative balance sheet, I should say. So, conservative balance sheet, and one more as well. The operating margin compared to competitors it's okay if it's lower, but it's better to see it growing towards meeting its competitors' operating margins, to show that the company has a good future of operating margins ahead, which is a very good sign for an investment. So that's all I'm going to do today. Hope you enjoyed that video. It's pretty technical, I'd say, but we got through it. I'll see you in the next one. Peace.